So the real estate market has seen the fastest climb ever. Prices were up 25% over the last year, and it's more than 30% if you go back 18 months. So the question is why? It's probably not immigration, because relative to before, we've had very few people come into the country over the last year and a half. And it's probably not supply chain issues, because we don't really need anything from other countries to buy real estate. Like, the land and the buildings are already here. The building supply is an issue because we know for the longest time it's been hard to build very quickly in Canadian cities. But this has been an issue for a long time, so it's not anything new. What is new, however, which started in the beginning of the pandemic, is the government worked together with the Bank of Canada to inject $400 billion into the economy. And they lowered interest rates so it's cheaper for the government to borrow money, and they pumped the system with excess liquidity. And of course, more money around bids up prices of houses and it makes things more expensive. So that huge deficit spending and pushing the cost of borrowing down can explain almost all of the price increase since April of 2020. A deficit happens when a government spends more money than it takes in, and next year the federal government expects another deficit of $144 billion. But I think the actual number is going to be higher. And this is likely to continue because most policymakers have no clue what they're doing. They only know how to spend other people's money, but don't have a grasp on basic economics. It's hard to blame them because they're not incentivized to help the average Canadian. It's like if your rich friend comes over to your birthday party and he asks if you want a pair of new sneakers or a new car. Of course, you're going to choose the new car because it's not your money being spent. It's the same thing when governments spend money. They don't have money to begin with, so they have to get money from somewhere. It can come from taxation, which is not likely going to be significant enough to move the needle, especially when the economy is still below pre-pandemic levels. They can get the money from borrowing, which they'll have to pay back, but again, they're not really incentivized to pay it back. So this leads to the final option, which is inflation. And we're seeing the result of this in food prices, housing prices, and even the stock market because of the $400 billion added to the economy over the last year and a half without any real economic growth or production. And the people who bear the brunt of the cost of inflation are middle-class households. I don't know if most people in government are ignorant or incompetent or intentionally misleading Canadians, and I don't know which is worse. But here is Pierre Poilievre, a member of the Conservative Party, the official opposition, and he just put forward a simple question to 10 different government officials who are responsible for spending on this new bill. And this video went viral because they couldn't answer him. So here's a clip.
How is the government paying the $7 billion bill associated with this proposal?
That question is directed to who, Mr. Poilievre?
Anyone who wants to answer it. If they have anyone over there that is concerned about where the money comes from, that person could speak up. Anyone here from Finance Canada?
I see Mr. Baylor.
Mr. Chair, I can provide a high-level response, but I'm afraid I won't be able to answer directly the honourable member's question because we're here to discuss it. And what I can say with regards to the cost of the measures in terms of Part 1, the three first programs that I mentioned, the hospitality, the tourism and hospitality recovery program, part businesses recovery program, and the local lockdown program have a cost of $3.2 billion.
And where's sorry, Mr. Baylor, where's the money coming from?
Well, Mr. Chair, that is within the government's broader macro economic framework, and I'm not I can't speak to that.
So you don't have anyone. It's just that we're being asked to vote in favor of another $7 billion of spending. And the obvious question is, where's it coming from?
Mr. Chair, as I indicated, I can discuss the contents of the bill, and I appreciate the question, but I can't answer that question.
Well, somebody's paying for it. Who is it? Did the tooth fairy? No answer.
Are here respectfully to answer questions to C2 as we study it.
Right. C2 has a $7 billion bill. That's the price tag. Right. That's what I'm asking about. Where's the $7 billion coming from? There's a lot of people are willing to talk about how they're spending the money, but no one wants to talk about where it comes from. 10 witnesses to tell us about how to spend money, but not a single one to tell us where the money comes from. I'm just worried that the answer is not one my constituents are going to want to hear. Because right now, I have 30-year-olds living in their parents' basement because housing inflation has priced them out of the market. I have single moms in my neighborhoods that can't afford a healthy basket of groceries to feed their kids. I have seniors whose savings are being vaporized by inflation. And now we have the prospect that deficits are going to drive up interest rates. So you can forgive me if my focus today is not on all the wonderful things the government's spending money on, but instead on where the money comes from.
So you can tell me incompetence or willfully trying to hide the truth. The problem with the government consistently running deficits is that eventually it's going to hurt the currency. And in recent years, that's exactly what happened in Turkey, a country of 80 million people. Inflation has gotten out of control. The Turkish lira collapsed in value, at first slowly, and then just took a nosedive. They even halted trading on the stock exchange to prevent it from falling too much. Can you imagine the cost of your utilities going up by 57% in a year? I'm not saying Canada is going to follow the same path as Turkey. We're very different countries, but we have been in a slow economic growth but high inflation situation before. Canada had massive deficit spending during World War II, and then afterwards, we had a lot of debt. So the country reduced its debt burdens by financial repression. This basically means allowing for inflation to run higher than usual while keeping interest rates relatively low, which is kind of like what we're doing right now. The 10-year government bond had its yield suppressed for over a decade after the war ended. Eventually, the economy grew and the debt to GDP ratio declined. Not so much that we had less debt, but it's more like we grew our household incomes and tax revenues to be able to service that debt. But I'm not so sure our government can lead us back to normalcy, because in order to fix a problem, you have to first acknowledge that you have a problem. But our finance minister doesn't even know how much debt we have, or she just doesn't want to acknowledge it. Here is Pierre again asking our Minister of Finance some basic questions that I'm actually interested to hear the answers to as well. But instead, we just got this.
What is the total amount of public and private debt in Canada today?
We are going to give a full report on Canada's public finances on Tuesday, but I am happy to say that the net worth of Canadian households is up 22% from the beginning of the crisis, and that in Q3 the household savings rate was 4%.
The question is
was 11% compared to 3.4% in.
Sorry, Minister.
Right.
Remarks.
The question was, what is the total debt level, public and private, in Canada today? Just looking for that particular number.
And I am happy to say that on Tuesday, just a few days from now, we're going to give a full public accounting. But I am pleased also to remind the member that the savings rate of Canadians was 11% in the third quarter, up from 3.4% between 2010 and 2019.
Question for Mr. Leswick. Does he know the total debt, public and private, that exists in Canada today?
I believe that the rule is that the questions go to me here.
Is he a witness? He is a witness.
I'm
thought
not
he might have the number.
Witnesses do
Questions
have
can be posed to him.
Yeah,
Okay, Nick,
yes.
go ahead if you wish.
I apologize to the member. I don't have that number at my fingertips.
That's a pretty important number. I'm amazed that a Minister of Finance and a senior finance official would not know how much debt there is in Canada today. What would be the total cost for if there were a 1% average increase of interest rates on Canada's national debt per year? Just the number.
And here, just let me say, when we publish the economic and fiscal update on Tuesday, we will include, as we did in the budget, as we always do, downside and upside risk scenarios, and those will include a careful accounting.
So is there anything we can do about all of this, especially when it comes to protecting our finances and mitigate the inflation tax on our own money? Well, first of all, it's probably not a good idea to store cash long term. Inflation's at 4.7%, which is the highest it's been in 18 years. So that's why you're incentivized to spend your money, do some Christmas shopping, maybe get some new appliances. And who does this benefit? Companies, basically. So the first thing that I'm doing is looking for value in the stock market. And when I find a stock I like, I sell a put option on it for the opportunity to buy the stock at a cheaper price. For example, in October, I looked at Aecon Group, which is a construction company. It's a value stock with strong fundamentals, and at the time, it was trading at $19 a share, which I thought was pretty good valuation. Like, it wasn't expensive, but I wanted to see if I can buy it even cheaper, so I sold a put option with a strike price of $18, expiring a month later. On the date of expiry, the stock fell to $17 a share, so my put option was a sign. I bought the stock at 18. Thanks to the premium I earned from the option, my cost basis is $17.71. And at this point, what I did was just sell another put option with a strike price of $16. Because if I'm happy owning the stock at $18, then I'd be even more happy to own it at $16, even cheaper, assuming the company doesn't fundamentally change in some way. Continuing to buy stocks allows me to keep ahead of the inflation game thanks to the Cantillon effect. That's when monetary stimulus helps some people more than others. If you want to know more about this phenomenon, you can watch my previous video up here. The other thing I'm doing is continuing to renew my mortgage at a variable interest rate. A fixed rate mortgage just isn't worth it right now. There are talks of multiple rate hikes in the next year and the year after, but I think that's way too optimistic. I think it's more likely we'll see 1 or 2 rate hikes and then more cuts, actually. And the last thing I'm doing is to not pay down my debt any more than I need to. This means making minimum mortgage payments and not making lump sum payments to my mortgage or margin account or anything like that. With the current inflation rate at 4.7%, this means the banks who lent me money are losing roughly $100,000 worth of value every year just due to inflation, and their loss is my gain. So I'm gaining $100,000 in value just by doing nothing. And this is more than I get than working at my full-time job, which I have to work 40 hours a week. So as long as we continue to have negative real interest rates, it wouldn't make sense to pay down low-interest debt. It's even more extreme in the United States, where real interest rates are now lower than they've been in generations. You are literally getting paid to borrow money. If you're curious to know more about that and how negative real rates affect your portfolio, you can watch my previous video here. Anyway, thanks a lot for watching. Don't count on other people, especially the government, to watch out for your finances. Happy investing, and until next time.